Nifty Top 10 Equal Weight Index Fund. Will investing in this NFO help you in your wealth creation journey? Will it add a good value to your investment portfolio? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. Before analyzing whether the DSP Nifty Top 10 Equal Weight Index Fund will be a good fit for investment portfolio or not, let us understand a few basic details about this NFO first. So as an NFO, it opens on 16th August 2024 and it closes on 30th August 2024. And some of its key features are, it is an open-ended fund type which has Nifty Top 10 Equal Weight TRI as its benchmark index. It belongs to the category of equity large cap, and the fund managers for this NFO are Mr. Anil Jalani and Mr. Dipesh Shah. And the minimum application amount you need to start investing in this NFO is just 100 rupees. And according to the riskometer, the risk involved in this NFO is very high. Now let's move on to the investment objective. So the primary investment objective of this index fund is to provide returns to the investors before expenses, which closely correspond to the total returns of the securities as represented by the underlying index, which can be subject to tracking error as it's an index fund. So this is the primary investment objective. Now as we have taken a good look at the DSP Nifty Top 10 Equal Weight Index Fund, now let's take a look at the Nifty Top 10 Equal Weight Index itself so we can get a better understanding of how this index fund will work. So NSE Indices has developed the Nifty Top 10 Equal Weight Index, which aims to track the performance of the top 10 stocks selected based on the 6-month average free float market capitalization from the Nifty 50 index. So the Nifty Top 10 Equal Weight Index can be used for a variety of purposes such as benchmarking fund portfolios, launching of index funds, ETFs and other structured products. Now let's take a look at the sectors represented under this index. So the sectors represented under this index are financial services, information technology, FMCG, construction, oil, gas and consumable fuels, and the highest weightage is given to the financial services sector by 36.61% of weightage, and the lowest weightage is given to the oil, gas and consumable fuel sector by a 9.74% weightage. So these are the sectors represented under this index. Now let's take a look at the top 10 holdings represented under this index. So the top 10 holdings are Infosys Limited, ITC Limited, Tata Consultancy Services Limited, Hindustan Unilever Limited, Larsen and Toubro Limited, Reliance Industries Limited, Kotak Mahindra Bank Limited, ICICI Bank Limited, HDFC Bank Limited and Axis Bank Limited. So the highest weightage and the first place in this top 10 holdings is the Infosys Limited by a weightage of 11.40%, and the top 10th holding is the Axis Bank Limited by a weightage of 8.63% weightage. So these are the top 10 holdings under this index. Now let's take a look at the index returns as on July 31st, 2024. So as you can see from the index returns represented in the screen and the graph, you can see that in 1 year it has given a return of 20.32%. In 5 years it has given a return of 16.61%, and since inception it has given a 14.65%. So according to this return index, we can see that according to the graph that in long term it has given good returns compared to short term. When in equity usually short term period can be a little bit volatile, but in long time it can give a stable growth with minimal volatility. Now we are going to analyze whether the DSP Nifty Top 10 Equal Weight Index Fund will be a good fit for investment portfolio or not by analyzing the pros and cons of investing in this NFO. So first let's take a look at the pros. So the pros are, it invests in a diversified portfolio that are likely to deliver you with long-term growth with minimal volatility, and also it invests across various sectors, and compared to an actively managed fund, the returns from this fund are relatively stable with less volatility. So it might be suitable for an ultra conservative investor who's looking to add passive investments to their core equity portfolio. So this fund is free from fund manager bias. So as it is managed passively, it is expected to have lower expense ratio than actively managed mutual fund schemes. So these are some of the major advantages of investing in this NFO. Now let's take a look at the cons of investing, that is the disadvantages of investing in this fund. So as this fund invests in predominantly in equities, it is not suitable for short-term investment, because as I have already previously mentioned that in short time in equity especially, the market can be a little bit volatile and highly unpredictable. So it's better to invest in it for long-term period, because the market cycle would also get completed in a 7 to 10 year long-term period, and you can get expect potentially higher returns and stable returns. But in a short-term period, the market will be highly volatile and highly unpredictable, where it can go to high to low in seconds, where it can go through a period of negative returns, no returns. So it's best if you invest in it for a long-term investment, because in short-term investment it can be highly risky and not suitable for your short-term investment portfolio. Because if you want to achieve your short-term financial goal through investing in this, then it's better to avoid, because it might not be suitable for you. Also, as an index fund, it is not a guarantee it will definitely perform according to how the index is performing. It can also underperform its index due to certain factors. Also, as an index fund, it only tries to replicate what the index is performing. So this fund will not be able to deliver you with market beating returns. It can beat the index itself. It can only replicate how the index is performing. Also, as I have already said, it will only replicate how the index is performing. It will not change its allocation dynamically based on the market outlook. Just because something is performing well doesn't mean the fund will change its allocation dynamically. It will only try to replicate how the index is performing with what it has. So as an index fund, they don't do any analysis on the underlying stocks and check the soundness of the company in which they are going to invest. They will only see how the index is performing in an overall point of view, rather than conducting an individual analysis inside the securities represented under the index. So if you compare this with active funds, in comparison they can take calculated risk, because they analyze all the stocks and choose only the best. They conduct individual analysis of the stocks, which is not present in an index fund. So also the major drawback of index fund investment is tracking error, since it may not also perfectly track its index. As it only tries to replicate the index, the major drawback here is it may not perfectly track its index also. So as an index fund, as I have already said, it's not flexible and not be able to take any course corrective measures during the market correction or market crash period. So it can be highly inconvenient for you if you want a dynamic fund allocation in your fund management. So you cannot expect that. So this might not be suitable for you as well. So these are some potential risks that you need to carefully consider before choosing to invest in this index fund. So what is the final takeaway from our analysis? Should we invest in the DSP Nifty top 10 equal weight index fund or not? Is it worth investing or not? So it basically boils down to what kind of investor you are. So this might be suitable for an ultra conservative investor who's not willing to invest in actively managed funds at all. But even then, our personal opinion is there are similar index funds out there in the market that have a lower expense ratio and a lower tracking error compared to this NFO. So if you do want to invest in an index fund, you can invest in an index fund that has a lower expense ratio and a lower tracking error compared to this NFO. And also, if you're willing to take a little bit of risk and you're willing to invest in it for a long term period, actively managed funds have the potential to deliver higher returns than an index fund like this. Also, if you're an investor who expects dynamic fund management and you look for investments that can beat the market itself, then you should definitely avoid investing in this fund, because as an index fund, it will only try to replicate how the index is performing and not beat the index itself, and you cannot expect dynamic fund management from this also. So it's better if you avoid investing in this fund. And lastly, if you have doubts whether this will be right fit for you or not, or what can you invest based on your risk tolerance and investment horizon, then you can definitely consult with a professional like a certified financial planner who will be able to guide you through the entire invest process and journey and make it hassle free and smooth for you. So you can definitely consider investing through a professional like a professional financial planner as well for a better financial future.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.